there was an interesting article by an editorial by Bill Dudley, who used to head the New York Fed and was a very powerful Fed member for many years and is an important voice in the whole monetary discussion that we have in this country. And he believes that, in fact, inflation has now been whipped. He has seen too many signals from the markets that suggest to him that inflation really is at 2% or maybe a little bit lower. And he thinks that to hold on, I think he's perfectly happy if the Fed were to lower rates in September, but to hold on beyond September, he thinks we would risk a recession. Now, I hear the idea that, oh well, maybe a short, shallow recession is something that is a price we can pay. Well, it's hard to control these things, and you might remember that through the 2010s, we were fighting disinflation. We had inflationary rates which were hovering around zero, slightly positive, slightly negative, depending upon the month that it was measured. Maybe it got up to 1% and then slipped back down to 0.75%. Our monetary policy is not geared to handle disinflation, deflation. That's why the Fed took such extraordinary steps as to lower interest rates to zero and actually had discussions about making them negative. There were only a couple of countries in the world that made them negative during the 2010s. One of them was Switzerland, and I can't remember the other one. But the world's monetary system works better when there's a little bit of inflation in the system. And what I mean by a little bit is the greater minds than me have determined that anywhere from 1 to 2% is, that's probably the sweet spot. That's where we want to be. So I think the market is correct in thinking that we're very close to seeing interest rates get cut, and that when interest rates go down, that's a very important support mechanism for long-dated assets, which stocks are. So seeing earnings continue to go up, that's important. We've got to continue to see that. We're in the beginning of the second quarter reports, and so far they're looking pretty good, as we heard at our research meeting today. They're beating analyst expectations. But if we have continued strong earnings and strong cash flows, and we in fact see interest rates come down, those are going to be two very important support mechanisms for the stock market. Back to you.
Thank you, Peter. In the interest of time, I'm going to actually combine items 3 and 4. One is about labor and one is about regulation. So I hope you don't mind if we squish this a little bit. Let me read the two positives that Peter's going to frame his argument around, and I'll read you the two negatives that I'm framing my argument around. Regarding labor, the labor market has improved and shortages have been mitigated. And the second half of that is we're expecting a more lenient regulatory environment and perhaps some pro-business agendas that are being proposed, probably by both parties in their platforms.
Mm-hmm.
So labor and business.
Right. So certainly the labor market has improved rather dramatically over the last 18 months. 18 months ago, maybe 24 months ago, we were dealing with very tight labor markets and people successfully demanding for higher wages, much relaxed work environment. Essentially, it was the employees' market. They were the sellers, if you will, and corporate chieftains essentially had to say, yeah, that's fine. And we did have some labor inflation. Wages at one point in time were increasing at a rate of 6% per annum, and we haven't seen that sort of wage increase on a consistent basis now for quite a few years. That has pretty much gone away now. I'm not saying it's completely gone away. There are still some businesses where labor conditions are tight and labor, if you will, still rules in the around the negotiating table, but it's certainly loosened up a great deal. And then with regard to regulatory environment, there was a Supreme Court case. Now I think it's been 3 weeks ago, maybe 4 weeks ago. It's called the Chevron decision, or it's the overturning, if you will, of the Chevron decision. The Chevron decision was made back in the 70s, I believe. It might have been the 80s. And essentially, what that did was it empowered the federal bureaucracy to create all sorts of rules, i.e., the regulatory environment that we all know and love today. And as a consequence of that, business people will tell you that life has just been made a lot more difficult. Now, it used to be, you applied to do something, and then you would get an agreement. You would get the authorities to say, okay, fine, you can go ahead and do that. Now there seems to be another 30 steps beyond the original first step before you're allowed to do anything. And then business get frustrated, their legal bills go up, and they just get disenchanted with certain projects. And quite a few business leaders will tell you that because of the increased regulatory environment, business has been slowed at best and killed in certain instances, certainly quite a few projects. In our own business here, I mean, we're regulated. We, Baldwin, that is regulated by the SEC. And they have increased rather dramatically over the years their oversight of our industry, each year putting out more and more regulations, which makes it more and more difficult to do business, and it increases costs. And we're not the only ones. I mean, the oil business, the IT business, all businesses have been confronted with this. So, with the overturn of the Chevron decision, this strips a lot of that regulatory authority away from those bureaucrats within the federal government and is putting that into the court system. That's going to be interesting to see how that works. But now litigants are going to sit there and say, well, no, you, the regulator, don't have that power any longer. We can go ahead and do what we want to do, and it will be adjudged, if you will, if the case goes to court, it will be adjudged in the courts. So that's, I think the labor situation has gotten easier for employers, and hopefully the regulatory environment is going to be easier to do business. So off to you, Richard.
Yeah, it's funny to listen to economists and even some of the talking heads talk about unemployment going from 3.7 to 3.8 now to 4.1, and it's a number, and clearly they lose track a little bit of the fact that these are a whole lot of people that just lost their jobs and are probably wondering how they're gonna survive the next 6 months. But it does certainly become effective in getting inflation under control, because any worker that's fearful of his job is less likely to ask for a pay increase. And if the union is particularly sensitive to job losses, they may be a little less aggressive in any kind of confrontation with business. There's another point that I want to make about unemployment. As unemployment rises, it's possible that spending could indeed stall as people either become unemployed or are fearful of losing their job, or maybe fearful about the upcoming slowdown in business, and that could affect the slippage of the economy into that feared recession. So as joblessness grows, so does the opportunity for spending to stall. On the regulatory front, I think we're seeing a growing progressive agenda, at least on one side of the aisle, and a lot more discussion, which was absent for the last 40 years, of using industrial policy more in the planning function of the U.S. government's intervention in the economy. As many of us probably remember, Ronald Reagan famously said, the most terrible words in the English language is, "I'm from the government and I'm here to help." And that led to pretty much 40 years of a retreat of the U.S. government from the economy, especially the management of the economy. And I think the 3.5 years of the Biden administration so far, we've seen a little bit of a reemergence of talk about industrial policy. We've seen more industrial policy applications throughout the world. And as such, the government is intervening in the economy a little bit more. The good news is it's taken a little bit of the unfettered capitalism out of the system, which sometimes is a little harsh and maybe excessive. But at the same time, it's introducing government decision makers in positions where they might be deciding who's the winner and who's the loser. And as we know, government's kind of notorious for not being able to pick winners very well. You remember President Obama's solar energy company that went bust. But then at the same time, just as that happened, about a year later, the U.S. helped a entrepreneur named Elon Musk get through his crisis with Tesla. And that one turned out much better than Solarna, I think was the name of the solar energy company. So in that particular example, they were 1 for 2, which isn't bad. But I think most people think the government's probably not the best decision maker relating to economic future and who should be encouraged and who should not.
As they're finding out in China.
Yes, indeed. That's a perfect example. And it's funny, it seemed to work so well in the last 10 years or up to the last 2 years. But there must have been some tipping point where once they got to a certain point, the intervention became excessive and harmful.
Mm-hmm.
So the last topic, which has more to do with what's happening in the market on days like today, is the great rotation. Somebody described what's happening in the market right now is the rotation that was heard around the world. And suddenly the Magnificent Seven are faltering, and there seems to be more interest in some of the rest of the market, the other 493 companies in the S&P 500. All of a sudden, small cap seems to be more interesting to people. And the question is this a rotation that we're likely to see? It might even extend the bull market because it's making the market rebound, the bull market broader, and therefore could conceivably extend it. That's the positive side of it. The negative side of that is often the last gasp of a bull market show these same kind of excesses, moving toward other parts of the market, hoping that there's still some life left in the bull. Peter, can you take the glass half full side of this argument?
Sure, I can, but I think we've got a question, Richard. Chrissy, do you? Yeah.
Yes. Given the facts that corporate profits are doing well, that interest rates are likely to be cut, and increase in dividends, increase in cash flows, and decreased inflation, although not for the consumer at the grocery store, an improved labor market and increased wages, and a repeal of Chevron, why the GOP narrative remains one of the failed economy and a failed America?
Wow.
I
Peter,
would
that's
never.
your question.
That's your question, Richard. You're set up for that one.
It's funny. I think there's a divide between, I won't say truth and perception, but I mean the economy is very strong, and they're very, very positive signs. But if you're coming into if you're trying to make your inroads, you might try to bend perception a little bit. Is that a fair way to say that?
Yeah, I think that's absolutely accurate. The facts don't support that statement by Mr. Trump. Uh, there's no economist, there's no analyst today that we read, that we talk to, who would support that position. The economy is doing very well, has done very well now for several years. The stock market is near all-time highs, only having achieved those highs very recently. I mean, it's just dropped off a little bit. Corporate America profits, as we've shown you in a couple of charts, are at all-time highs or near all-time highs. Inflation is certainly going in the right direction. I mean, those are facts. Where some people come up with their statements, I don't have the faintest idea. They never seem to substantiate their positions. I've not heard any of these people who are moaning and groaning about the economy come out and mathematically substantiate a position that they've taken. So
Well said. Well said.
okay. Now what? So where were we now? On
So
the,
let me read your premise here. Small cap is suddenly robust
oh, right.
and a strong rotation into broader market participation. Too early to tell? This is a head fake?
Yeah. So various writers have posited now for quite a while, as they've looked at the stock market go up rather dramatically, and the leadership in that market be so narrow. I mean, again, we've mentioned the Magnificent Seven. So you've got 7 stocks which have generated most of the performance of the S&P 500. And this unnerves people because it doesn't look like it's a well-supported market advance. So there are 1 or 2 ways that this is going to end. One way, which is not the happy way, but one way is that the Magnificent Seven implode. I mean, much like what happened back in the early 2000s with the internet bubble. All those great names, that led the market, and it was still a rather narrow market, imploded, and they were no longer allowed to sell at 40 or 60 times earnings. They had to come back to earth with the rest of the market and sell at 12 times earnings. And that was very hurtful to a lot of clients' portfolios. But the other way that this can end is that, okay, the Magnificent Seven have gone up rather dramatically, but there's support for that advance, i.e., their earnings have also gone up rather dramatically. We don't know because I think a lot of the big tech names are going to report next week. We've had 2 important ones report, I think it was yesterday, Tesla, which was disappointing to the market. It's part of the Magnificent Seven, but I don't consider it a tech stock, really. It's an automobile stock. But be that as it may, and the other one was Alphabet, i.e. Google. Google reported strong earnings. They beat on sales, they beat on earnings, what the street was expecting. Why the stock's off in particular today, I'm not exactly sure, but I guess some people are in a mood. Next week we're going to get more of the tech names, the Magnificent Seven, reporting. So if they come in as they're expected to come in, or even better, and certainly if they mimic what they've done in the recent quarters in the past, that's going to be important support for their current pricing. And in fact, some might say, oh, well, maybe they should go even higher because their earnings, the street was expecting a 30% increase, and they came in with a 50% increase in earnings. And so we'll wait to see that. So if these large cap names start to get shunned and people start to look elsewhere, hopefully we have earnings support to at least keep the Magnificent Seven stable. So they don't crash and burn. They just sort of say, okay, you're continuing to do well, but there are a lot of other companies. There are another, 493 companies in the S&P 500 which haven't participated to the same degree, and their earnings are increasing more rapidly than the street is expecting. And that's where you get the broadening out of the market. That's where the leadership will switch from just the Magnificent Seven to now maybe another 150 names in the S&P 500, and more names in individuals' portfolios are going to participate. So I think that's the way it's going to turn out, as long as earnings continue to move forward as they have been, and we're on the precipice of declining interest rates. I think you're going to see the leadership of the stock market broaden.
Well, it's interesting, Peter. You can accept that case and still make a case for a correction. And that same guy that I talked about earlier, the Ronald Krasinski, made the point this morning that sometimes small corrections, like a 10% correction, is healthy because it could be accompanied by a rotation into a more broadened bull market. And that we could have a 10% correction while the Mag 7 gives back some of its gains. The leadership shifts maybe to some of the other sectors. Maybe, as we saw today, the utility sector may be one of those sectors. And that's actually consistent, as we've been telling clients, it's consistent to think utilities might be a really promising place to invest, because artificial intelligence is very, very energy intensive. So intensive that some people are planning AI activity for which they don't yet know how they will power. So they're buying AI potential business without having addressed the power question there. So I wouldn't be surprised, and I actually almost, I wouldn't say rooting for it, but I'd like to see a rotating correction where maybe some of the pressures you say is off those big names, and some of the lesser known names, or some of the neglected companies that are perfectly good companies get established as leaders of the next part of the cycle. And I think that would be a positive way to have a correction and a change in leadership.
I don't disagree at all, Richard. I think we're, sort of saying the same thing. You're more tactical. I'm sort of a little bit longer view. I markets that go up dramatically historically have typically corrected by 10% or maybe even a little bit more. And that's perfectly normal, and nobody should get upset or worried about that. It's refreshing, it sets everybody back a little bit, and they sit there and say, okay, now we got to reset our expectations. And then you shake out, if you will, funny money. You shake out weak money, weak hands. They'll go off, and then you get real long-term buyers back in the market, more stable hands, long-term holders of stocks. So I don't disagree at all. I think we could, and I think you're right. Maybe it would be refreshing to have such a correction. We've got a couple of questions now.
Yep.
Chrissy?
Yep. The first question is, has consumer purchasing power gone up or down in the past 4 years?
Hmm.
You're more equipped than I am to handle that, Peter.
Well, I think it's. I think it depends upon where one exists on the asset stack, if you will. If people who are well off, I think their purchasing power has done nothing but go up because their asset values have gone up. Actually, everybody's asset values, if you own a home, typically most people's most important asset, that has increased in value. So certainly your wealth has gone up. And if you've got a 401k, that has gone up. And I don't know about one's salary. That probably has also gone up. And so while we had a bout of inflation and reminded people about how pernicious inflation can be, I would say probably uh, overall people's purchasing power has gone up. Certainly their asset base has appreciated in value. And as you go up the economic scale, if you will, and you're less dependent upon a salary, and you've got other means of supporting yourself, and you've got other assets, maybe you have other real estate, you've got just other things that probably have gone up in value. Yeah, I would say that yes, your purchasing power has gone up. Certainly, your asset values have gone up, and how you translate that into purchasing power, that's dependent somewhat on what assets you're going to liquidate.
There's a follow-up to that. Where do you see purchasing power going in the future? And is purchasing power a reflection of the economy as a whole?
Let me try that, Peter, if you may.
Yeah.
If you, we've been at Arcam, we've been exceedingly focused on purchasing power and trying to protect assets from the inflation effects that we anticipate. Enough that whereas we used to have about 5% of our assets in alternative assets, we're now up to 25% of our assets in alternative assets. And those include things that are inflation protected securities, not treasury inflation protected securities, but things like real estate, infrastructure, energy, things that do well in a more inflationary environment. And I think that it's incumbent on us and our clients to recognize that in inflation, we may be over inflation for this cycle, but probably given the spending plans of the United States government under any scenario is likely to be inflationary. It's going to be tougher and tougher to stay ahead of inflation.
I think Richard is absolutely correct with that. We've often talked about a concern that we have about our dollar. Our currency is considered to be the reserve currency of the world. And because of that, we're allowed certain freedoms that no other country is allowed in the world. We can run consistent massive deficits, which build tremendous debt, and yet people will still buy our treasuries. They'll still finance us. And that's because we are considered to be the world's leader politically, economically, militarily. We took on that role from Great Britain early in the 20th century, well, I think it was just after World War One. We had now arrived upon the scene, and we were the power of the world. We have been abusive of this position now for quite a period of time by running all these tremendous deficits and building up all this debt. As a consequence, the risk of inflation grows with every year. And I don't mean just inflation, I mean inflation that can really get out of control. If we get to a point where buyers of our treasury debt no longer have faith, no longer believe in the economic power of the United States and our capitalist system, they will begin, and an alternative has arisen. That's the important point. There must be an alternative. People can't just sort of say, well, I've lost faith in the United States and that's it, I'm going to go somewhere else. Well, where else can anybody go? There's no other currency in the world. There's no other currency market in the world that's as broad, as deep, and is as liquid as the US dollar and US Treasury market. And so, unfortunately for outsiders, They're sort of hooked to us. And until there's an alternative, and the euro is not an alternative, people have diversified their currency holdings to a certain extent in the euro, but it's not as big a market as it needs to be. The renminbi out of China, the Chinese have been trying to make that an alternative. That's not an alternative, especially because there is no free flow of capital. So nobody would tolerate that. I mean, once I, turn my dollars into renminbi, I want to be able to turn it back the other way or some other way if I want to, and they don't allow that. So it's the renminbi is not going to do it. The euro is not going to do it. The yen tried back in the 1980s. I don't know if you all remember, but in the 1980s, the Japanese were supposedly the wunderkind of economic management. Business schools started teaching business courses and Japanese management techniques. The Japanese were buying so-called, there's star-studded properties. I can't think of the right term, but I mean, like Rockefeller Center. But Japan was going to take over the world. Japan was going to supersede the United States with regard to its economic power. And it didn't happen. In fact, the Japanese now are number 3. They're behind the Chinese. So we are still, fortunately for us, the only game in town. There is no alternative. That still allows us, unfortunately, to behave badly, running up deficits and running up debt. But there will probably come a day. There will come a reckoning.
The next question is, do you have any comments about international investing outside of the U.S. and will the international market growth ever exceed U.S. market growth?
It has in the past. So I don't see any reason why it couldn't in the future. I mean, certainly the growth of the U.S. economy and the stock market here in this country has been pretty spectacular over the last 15 years. International investing, as compared or versus U.S. domestic investing, they sort of go in cycles. Typically, the cycle has lasted somewhere around 10 years. So we've been in an extremely long cycle of U.S. dominance as far as stock market performance. Now, it wasn't last year, it was the year before where there was a slight outperformance. I mean, very slight, by 0.5% or something like that, where international markets outperformed the U.S. market. But we have been in a long cycle of U.S. outperformance. Do we think it's going to go the other way? Yes. Well, that's why we've been believers in international investing, not just to catch a counter-cyclical move against U.S. investing, because there are some really great companies that are headquartered internationally, aren't based in the United States, and you're sort of foreclosing the opportunity to invest in those companies unless you do go overseas. Right now, in the all-country world index, the United States is now about 60 to 65% of that index. It typically is less than 50%. And so one could say that in the index, just simply because of recent performance, the U.S. is way overweighted. And so you might want to think about counterbalancing by increasing your percentage ownership in international names, thinking that, well, one day it's going to swing the other way. One of the sparks to having it swing the other way is a weaker dollar. We've had a strong dollar now for quite a while, but if we were to get a weak dollar, and certainly Mr. Trump has talked about the U.S. dollar is way too strong, we must weaken it, it's hurting our exporting, and it does hurt our exporting. So if there were political plans to somehow weaken the dollar, you could see investors start saying, okay, time for me to shift money out of the US and move it overseas.
Let me just add to Peter's comments by saying that Europe, which had pretty much a short, shallow recession last year, is poised for much better growth over the next 12 to 18 months, perhaps even than we are. They've typically lagged, but they've lagged to the point that there's some pent-up demand that's probably going to be recognized this year. But the country that really impresses all of us is India. And not only have they maintained a pretty high level of growth over the last, half decade, but the value of the Indian stock market has surged. Actually, China always used to be the biggest share of the emerging markets index, and the India stock valuation as part of that index is now approaching that of China. So if you just plot the two charts next to each other, India should emerge through the next 18 months as probably a bigger share of the emerging market index than even China, especially with China in kind of flat to down mode, which they are right now. So we're not particularly enthusiastic about some of the rest of Asia, but we're very enthusiastic about India and to a certain extent Japan. But Europe, I think, is very promising as well. We think in terms of ETFs positioning in a continent or within a couple of industries in a continent, whereas Peter's people are picking individual names, individual stocks to own in those regions. Like we'd be buying the ETF that owns Sweden, whereas you'd be more likely to buy a Swedish company.
Correct.
Any other questions, Chrissy?
I have a couple. I just wanted to make sure that people know you can go ahead and raise your hands in the system if you have a question using that reactions button on the bottom of your screen, or *9 to put you in the queue, and I will I'll keep an eye out for that. In the meantime, I have a question here. The Fed was slow to react to the surge of inflation 2 years ago. Are they likely to be slow again to react to the need for rate cuts today?
You want to start? You want me to start?
Why don't you start? I think we're going to answer it the same way.
Okay. I think, as I mentioned earlier, the considered wisdom is that we're very close to the Fed beginning to cut interest rates. Now, is it too late? We've certainly seen some recent softness in some of the economic numbers. We've seen unemployment go up. We've seen inflation come down. So is it too late? We don't think it's too late. Some would argue, as Mr. Dudley argued in his editorial today, that the Fed should do it in July, right now. The Fed meets next week. I don't think we think that there's a huge difference between having the first cut in July and having the first cut in September. They're not going to cut, we don't think. They're not going to cut, 75 basis points off the Fed funds rate. It's going to be in 25 basis point intervals. So they were going to be small cuts, and so it would be a series of small cuts. So, but I think the market would be very disappointed if there was any indication that, oh no, we're going to wait till next year, 2025 in the spring, before we cut interest rates. That might be too late. The recession might gather some steam.
Exactly, and I was going to make the point, Peter, that the worst thing that we would see is if they decide not to cut interest rates because of the political cycle. That would be and I think in the past they've maybe been sensitive to that. I hope they're not sensitive to that this year, because whether it's July or September, I think they need to cut sooner than November.
Yeah.
We're just about at an hour since we started. Shall we make this the last question to Chrissy?
That's fine by me. The last question will be, will the first rate cut by the Fed ring the bell and bring the traders out of the woodwork to buy stocks?
So you want to go ahead, Richard?
Yeah, I just read an article day before yesterday, and Peter, I've mentioned this to you. You didn't agree with this guy. Grant's Interest Rate Observer has been around for, I feel like 100 years, probably not, but it's been around since I've been in the business in the early 80s. And he's thinking that the rate cuts might be the opposite, exactly the opposite, that it's not basically going to bring out the traders buying stocks. That's going to be a signal that the bull market is over. And that's kind of hard to fathom that, except that, loosening of monetary policy is a sign of a weakening economy. And so his argument would be that that's a sign to sell, which I'm not sure that that's correct.
I would agree. I don't think it's correct at all. I think that there's an old saying on the street where you buy the rumor and sell the news. So you can see in the markets as they've risen over the past quite a few months now, that was the rumor that the Fed was going to cut interest rates. And now when we get to the point where they cut interest rates actually, well, now we're going to sell the news. That would seem incongruous to me because I don't think that the economy is weak enough to signal that there's really any weakness in the economy. Maybe there's a little bit of softness, but there's no weakness in the economy. Again, as long as we continue to see earnings going up, cash flows going up, dividends going up, then that's a very powerful support mechanism for stock prices. When you actually get the first cut in interest rates, now we have confirmation of the rumor, which we had been, buying on. Now we have actual confirmation, and we will also probably get affirmation that over the next several quarters, presuming that the economy unfolds. Remember, the Fed is very data dependent these days, but presuming that the economy unfolds as they're anticipating it to unfold, they'll probably affirm that interest rates are going to continue to go down. And lowering interest rates, i.e. lowering the cost of money, is a very powerful support mechanism for long dated assets. And that's exactly what stocks are. They are long dated assets. That means when interest rates go down, stock markets can sell at higher PE ratios. It's simple math. So I don't think that the first interest rate cut is going to generate a wave of selling. There may be a short term, oh, we're going to sell the news. But again, that's a tactical move. I'm talking about strategic moves. If you have increasing earnings, cash flows, and dividends, and lowering interest rates, the direction of stock prices should be up.
So just drawing a conclusion from your remarks, if indeed the market sells off, let's say 5% or even 10% after the rate cut, that's a buying opportunity. That's a long-term buying opportunity at that point. So correct. Let's gather our dry powder and meet here again when they cut the interest rate, and we'll all put that dry powder to work. How's that sound?
Okay, sounds like a plan.
Well, since I again drew the short straw, so it ended up me being the host, I want to thank our guest today, Peter Havens, for participating in this seminar, or not seminar, this client Zoom call. And thank you all. Thank you, Peter. Thank you, Christina, for managing this for us. And thanks to everybody for for joining us today. We really appreciate your interest and your support.
Thanks very much, everybody.